A very succinct presentation on the paradigms of Islamic finance. Here we will be talking about conventional banks, Islamic banks, home loan, education loan, and profit for Islamic banks. The backbone of conventional banking system is interest. Its only concern is borrowing and selling money, which is a fictitious and intangible commodity. All a conventional bank wants is to give loans and only being bothered about its repayment. For example, banks create money out of thin air. A small client loan at 5% compound interest gets blown to a huge amount just by changing hands. The client might lend further to his friend at 8% and it can keep increasing up to 50% compound interest. The actual money involved is quite less, but due to the curse of compound interest, it inflates into a whopping sum. Money is created, circulated, and sold without being backed by assets. This has triggered inflation, explosive economic situation, and inequality. Also, such unethical banks keep lending over and above its actual cash reserves. Because such banks trade in assets even before their existence, and because of the reasons that I've just enumerated, this most likely upsets the borrowing and lending chain, which in turn leads to hordes of defaulters, causing a domino effect. The global recession that we've just witnessed is nothing but the sum of the property bubble and the subprime credit crisis. Interest-based conventional banking system facilitates growth of debt to unthinkable levels. Let's look at an example. A $500,000 loan at 15% compound interest for a period of 15 years shoots up to 40 million. Now you see, that's real power I'm talking about, and power derived through simple mathematical calculation. Now most of you must be aware that the economic giants like European Union and United States have a debt burden of 16 trillion US dollars each. Compound interest is a blessing when you receive the loan amount, but a curse when you have to repay back. For developing nations, debt crisis translates into economic slavery. In case of secured loans, the conventional bank takes some collateral but still owns or co-owns nothing. On the contrary, an Islamic bank deals in actual assets and services. It trades in real commodities. An Islamic bank would invest in business, machinery, and infrastructure. As for assets, it cannot be compounded, and at any given point of time, there can only be a single seller and a buyer. Some real-world instances for the kind of business activity an Islamic bank might venture into can include the construction of a power plant, building highways, flyovers, and educational institutions. The products in Islamic finance are similar to equity, trade, and lease-based instruments, but at the heart of it all is the objective, which is to eliminate interest and of course allow legitimate profit. Under Islamic finance, debt is always fixed. Islamic banks acquire direct ownership of a real asset either through lease, partnership, or sale and trade. It always co-owns the actual property with its clients. Now, if we look at the example of home loan, the bank is directly involved in asset purchase through partnership, so an Islamic bank shares the risk and not just the customer who is exposed to it. This arrangement in turn prevents a financial meltdown. In such case, the client makes regular payments to the bank, which increments his equity, at the same time decreasing the bank's equity. Finally, a time comes when the client becomes the complete owner of the house, and no compound interest is involved. The customer only pays for the price of the house, which is the sum total of the cost of the house plus the profit margin of the bank. The payment is made through regular small installments, and because the customer already takes possession of the house, hence a rent has to be paid to the bank for that value of the house that is still owned by the bank. The rent is the product of the bank's profit rate and its ownership value for that period. As payments are made, both the installment amount and the rent of the home buyer goes on diminishing. His equity goes on increasing as the bank's ownership value goes on decreasing. Now, what if the home buyer goes bankrupt or insolvent? He will still have an equity stake in the property, which can be monetized to his advantage, something which is not possible in conventional banking. Let's talk about another example of education loan. Under Islamic finance, it's marginally just 20 to 30% more. Debt can never grow as it is always fixed, but under conventional finance, it's whopping 400% in excess. How do Islamic banks make profit? An Islamic bank allows equity under Mudaraba, Musharaka, and Sukuk, trade under Murabaha, Salam, and Istisna, and leasing under ijara. Under Islamic finance, debt is categorically prohibited. The interest-free principle of Islamic finance is not something unique. It is as much relevant to Jews and Christians. In fact, in 2009, the Vatican said that banks should look at the rules of Islamic finance to restore confidence amongst their clients at a time of global economic crisis. Another central principle of Islamic finance is that of risk sharing. The central juristic or Sharia principle of Islamic finance clearly states that there is no return without assuming risk. Under an Islamic finance arrangement, the profit and loss correspond to the investment proportion, and the Islamic bank tries to lessen the risk by taking part in the ownership. Islamic finance is primarily asset and service based. There is absolute contractual certainty under Islamic finance. Contracts play a central role in Islam. It means the existence of the subject matter at the time of the contract, the fixation of delivery date, and the mutual agreement of price at the time of the formulation of the contract. It clearly prohibits contractual uncertainty, conventional insurance, futures, options, and interest. Islamic finance is highly ethical. There is no buying, selling, trade in haram products and services which are impermissible by Sharia. Conventional banking, insurance, tobacco, and alcohol are certainly not allowed. Let us recapitulate and have a bird's eye view at the concepts that we've just looked so far. We talked about conventional banks. The main objective of conventional bank is borrowing and selling money which is fictitious and intangible. The repayment of a loan is what it is all concerned about. A small client loan at 5% compound interest can change hands, and in series of 8%, 10%, 15, 25 up to 50% compound interest leads to the creation of artificial wealth, the circulation, creation and selling of money from thin air, as that money is not backed by assets. This triggers inflation, explosive economic situation, and economic inequality. In most cases, it has been found that the conventional bank also lends over and above its actual cash reserves. It trades in assets even before their existence, which has created hordes of defaulters in the form of a domino effect. Bigger the loan amount, greater the damage. The price is paid by humanity and the environment. The recent global recession was nothing but property bubble and subprime credit crisis. And conventional bank also leads to unchecked growth of debt. A $500,000 loan in 15 years at 15% compound interest shoots up to 40 million. Economic giants like European Union and USA have a 16 trillion US dollar debt on each of them. The debt crisis for a developing nation translates into economic slavery. Even if a conventional bank lends a secure loan after taking a collateral, it still owns nothing. On the contrary, an Islamic bank deals in actual assets and services. It trades in real commodities. The activity of an Islamic finance can be investing in business, machinery, and infrastructure. The assets, as far as Islamic bank is concerned, cannot be compounded, and at any given point of time there can only be a single buyer and a seller. Some real-world examples can include the investment of Islamic finance for the construction of power plant, highways, flyovers, and educational institutions. The products of Islamic finance are similar to equity, trade, and lease. The primary objective is the elimination of interest, at the same time allowing legitimate profit. The debt, as far as Islamic finance is concerned, is always fixed, and there is direct ownership of real asset. It can be a long period in the form of lease and partnership, or short period in the form of sale or trade, and an Islamic bank co-owns actual property with its customers. Looking at the example of home loan, an Islamic bank is directly involved in asset purchase through partnership. This prevents financial meltdown, as the equity of the client goes on increasing through a series of small payments. The bank's equity goes on decreasing, and finally the client becomes the owner. As there is no compound interest, so the client only pays for the price of the house, which is the sum of the cost of the house and the profit margin of the bank. The client also pays rent to the bank for that portion or that value of the house which is still owned by the bank. In case of the bankruptcy of the client, the equity stake in the property of the client can be monetized to his or her advantage. Now, if we talk about education loan, if the education loan is taken by a student through an Islamic institution, then the student only has to pay 20 or 30% more, because debt once fixed will never grow in case of Islamic financial institutions, but in case of conventional banks it is 400% and more. Now, how do Islamic banks make profit? Certainly, Islamic banks allows equity-based transactions in the form of mudaraba, musharaka, and sukuk, trade-based transactions in the form of murabaha, salam, and istisna, and leased instruments in the form of ijara. It categorically prohibits debt. The transaction in case of Islamic finance is interest-free, which is something not unique to Islamic finance or Islam, because it is very relevant to Judaism and Christianity. In fact, in 2009, the Vatican said that banks should look at the rules of Islamic finance to restore confidence amongst their clients at a time of global economic crisis. Risk sharing under Islamic finance means that the central juristic or Sharia principle, it states that no return without risk. It means that the profit and loss in case of an Islamic finance arrangement should correspond to investment proportion, and an Islamic bank also tries to lessen the risk by taking part in the ownership. Now, an Islamic finance industry is primarily asset and service based. There is absolute contractual certainty. Contracts play a central role in Islam. It means that the subject matter has to be present at the time of the contract, the fixation of the delivery date at the time of the contract, and the mutual agreement over price. It prohibits contractual uncertainty, conventional insurance, futures, options, and interest. Islamic finance is highly ethical because it does not deal in buying, selling, or trade of haram products and services which are impermissible by Sharia, and it is not allowed to deal in conventional banking, insurance, tobacco, and alcohol. In the end, let's see what Allah subhanahu wa ta'ala says about riba, that is interest, in the glorious Quran.